Okay, I came across a pro forma yesterday, and I want to show kind of when you're doing a pro forma, things you can do to make it seem more realistic to investors. Because there was something in the pro forma that, I took a look at and it just didn't seem right to me. And I think this is going to be a common occurrence. So these aren't the exact numbers that came across, but let's just take an example where you've got a revenue of 1 million, 1.5 million, 2 million, $2.5 million, and 3 million from 2021 to 2025, a 5-year period. This is something typical you see. Now, that that revenue increase per year could be right, it could not, whatever. That's not what we're getting at. Here's the gross profit margin, which is the gross profit divided by that revenue, and here's the operating profit margin each year, which is the operating profit divided by the revenue. Now, by the way, when I look at pro formas, I always just go to the operating profit. Net profit is always going to be a little different because you've got other income and other expenses in there. Unless there's something unique about the business where they have significant other income or other expenses, I don't really care about it. I'm more concerned with the operating profit personally, although that could change depending on the type of business. But take a look at this and see what might be wrong, or from an investor perspective, an investor might question. Well, here's what it is how much the gross profit margin and the operating profit margin are increasing on an annual basis. My first question would be, why is that going on, especially the operating profit margin? The gross profit margin, there could be legitimate reasons why it would increase like that. And that could be that as you gain more volume, your cost of goods sold goes down because maybe you get your supply costs, you're going to be buying in bulk, so it's less if you're making something. Maybe you'll be able to do with less labor at each site. There could be legitimate reasons why your gross profit margin goes up, but you better be able to explain that. And you also better be able to explain, well, why don't you keep it constant and then pass those price savings along to your customers? Wouldn't that make your revenue higher? And that may or may not be true. If you are in a business where it's, you're the only game in town, you're monopoly, it may not make any difference, and maybe you should take those savings to your cost of goods sold to the bottom line in terms of profit. That could be a legitimate answer. But if you're a more commodity-driven business where there's a lot of competition, having your gross profit margin, assuming that's going to increase on an annual basis, a lot of people are going to have a hard time believing that, and that may not be the best approach from a strategic perspective as well. Going down to the operating profit margin line, this is where I would be really suspicious. Your operating profit margin is basically doubling over a period of 5 years. My question would be, why would that be? You're going to have, your operating profit margin is going to be your gross profit less G&A expenses that you're going to have. And what you're basically saying by this is your G&A expenses are growing at a much, much lower rate than your revenue. And that's always going to be tough for me to believe. I personally, I think a good rule of thumb is that your revenue, whatever its growth rate is per year for a mature business, you should probably be growing at about 80% of that. That's a rule of thumb. Different businesses could be more, could be less, but that's a good rule of thumb. For a startup, if you're showing a pro forma because you're trying to raise money or something like that, you're going to have a hard time getting anyone to believe that something like this is the case, or you better be able to explain why. Let me show you kind of how this probably should look like for most startup businesses to get investors to kind of believe, that it's going on. And I'm going to start by kind of taking a very generic approach and then showing you what it probably should look like. If your gross profit margin, and again, you should be looking to establish a growth profit margin by what the industry you're in is likely to produce. If you're producing something obviously that's brand new, you're gonna have to do a lot more work figuring out, what your cost of goods sold are, what your G&A expenses are likely to be, and it may be a little more unique But for a lot of industries, you can look at publicly traded companies, you can look at, published websites, things like that, and find out what these margins are likely to be. But it's going to look a lot more legit at a very base level if your margins just stay constant. And then, I as an investor, for your gross profit margin, let's pretend you're a restaurant, I can buy that. I can say, okay, 20% gross profit, their labor costs, their supply costs are going to hold steady kind of over time, and whatever their revenue increases, their cost of goods sold should increase by a similar percentage. And that's true for the most part. As your revenue increases, when you're running a business, you want your cost of goods sold to increase by about the same percentage. That holds your gross profit margin constant. That's probably about right. Your operating profit margin, I'd also feel a lot more comfortable if someone is showing that as a constant. They've done their research, they know that their business, they should be operating at about a 5% operating margin level, and they just hold it constant. They're assuming that, okay, as our revenue increases, as our gross profit increases, our G&A expenses are going to go up comparably. And by the way, I'd be fine if this was increasing slightly to reflect, hey, our G&A expenses are only increasing by 80% of our revenue increases. I could buy that, especially for a mature business. But for a startup, it would be totally fine if you did it like this. But here's the thing with a lot of startups. A lot of startups, their G&A expenses to start off the company, because remember, G&A expenses are indirect costs. They don't necessarily track revenue increases all the time. Now, as a manager, you should manage your G&A increases to make sure that your G&A expenses are growing by less than your revenue as a mature company. But a startup, if you have owner salaries, if you have marketing expenses, if you have research and development that you're doing, it's very likely that you're going to have a negative operating profit margin at first. And what an investor is going to want to see is just that this gets better over time. Something even as simple as, negative 3%, then negative 1%, then it gets to break even in year 4 and 2.5%. If I'm an investor and this is a business that should be operating at about a 5% margin at maturity, I'm totally fine with something like this, because I'm seeing, okay, they're spending extra in overhead at the beginning of their business. That makes sense to me as an investor, because that you're not going to be able to cover the salaries of, say that the CEO initially, or if you have a team, the team initially, research, maybe you're doing, a marketing blitz in the first few years that you're not going to be able to cover necessarily with your revenue. Something like this makes a lot more sense to me when you're doing a pro forma, but I would also want to see this taken out to at least where the operating profit is what it's going to be at maturity. Meaning, if this business, if it was mature as a 5% operating margin business, I would want to see this taken out to see when that happens, because that to me is the first point at which a business is mature, operating at full capacity, and I can tell as an investor what it's really worth. So this is kind of hopefully a good rundown for you of when you're doing a pro forma. Always pay attention to what your margins look like in the pro forma and whether they're realistic. Don't just do your numbers without any regards to your margins, because investors are going to look at your pitch and they have a really short time to figure it out. They're not going to dive in deep to each of your cost of goods sold and see if they make sense. They're going to go straight to your profit margins and figure out, do those make sense from the beginning, to get a sense of whether this person is, making serious financial projections or is just kind of throwing it at the board and seeing what sticks. So I hope that helps. Margins in general in pro formas.